Hi, this is Mark with ValueCharts.com. I wanted to talk about a few trades that I made yesterday and where we are today with soybeans. Basically, the soybeans market came down to a 60-minute trend line. This is actually not displayed, and it was also moderately undervalued on a 30-minute and 60-minute basis, or actually 30-minute basis, excuse me. And those two, I was using a confluence of indicators there to guide or try a long entry point at that support level when the market reached the trend line, as well as being moderately undervalued. Now, this trade actually didn't work out, so it ended up breaking down through the trend line. I had a defined stop, and I lost maybe $1,000 in the trade, which is fine. That's going to happen. That actually was a good trade because I had my defined trading rules. I followed the rules. I'm out. Now, this next trade was, now that it had broken the trend line on the 60-minute basis, I was looking at possibly shorting, or actually shorting the retest of that. And I actually did do that. So expecting that this market broke down through it, would come back up and retest it, and then would start selling off again. Now, the market actually did not end up doing that. As we can see, it actually corrected a lot more and came back up to higher levels, maybe right around or right under 1770. So, my mistake with the short signals, I really should have probably defined my risk there and gotten out. Now, in that context, I've been looking for this market to sell off near term. So I'm working under the confines of a bearish sentiment over the next couple of days. Now, I added several positions on last night to this trade, and I was looking at shorter term increment and momentum based ideology here. And if we look at this, I'm critiquing my work essentially, and really understanding that I could have done a better job with this by simply waiting for moderately overvalued price points within the 15-minute bar interval chart. So, that probably would have made my life a lot easier. I would have been able to achieve better fill prices, and I would be in a better situation than I am now. Now, I'm actually profitable in this trade, maybe $1,000 or so, with the expectation that this market is going to go down and sell off to test the 1755.5 level. I expect that to happen today sometime. And if it does break this level, then we very easily could see this market start to sell off all the way back down to 1700s, which would be obviously a nice trade. So I'm currently short 12 contracts here. I'm critiquing my own trading and realizing that I could have really done a better job with entering this market. I find sometimes that trading is a lot like dieting. You're not supposed to eat the buffalo wings, but every time you see those listed under the appetizers, it's really tempting to buy those. Now, we know it's not good for our health, but we end up doing it anyways. Getting back to our example here, one of the things that jumped out at me was that I could have done a much better job with my entry points if I had used the 15-minute price or bars or 15-minute bar interval along with value bars to identify strategic value-based entry levels. So if we look back over the past 12 hours, we can see 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15. We see 15 instances where these 15-minute price bars penetrated up into the moderately overvalued price level. So all of those right now are profitable. Had I selected to use any of those, it really would have put me in a better situation had I waited a bit last night to use those levels versus the levels I was using to enter. So I like the 15-minute bar interval. And then if I also look at the 60-minute bars, you'll notice that yesterday around 4 in the morning, the MQ momentum indicator turned negative. So we started to see negative momentum pick up there in the markets, and it's essentially stayed negative here for quite some time. And this could have been used as a great filter. So using this as a filter, then I can drill down again to the 15-minute bar interval there and identify these moderately overvalued price points as potential entry points for my trades. So it's always important, again, to use stop loss logic there, because we're going to be wrong. It's part of trading. It's a cost of doing business. But the idea behind what we're talking about here is that if we use strategic value-based entry points when we're trading the market, it puts us really in a fairly good situation with respect to having to risk less, or being very strategic and really putting us in a much more favorable position in doing so. So we'll continue to watch this market and see what happens over the next couple of hours. But This has been a very strong bull market over the past couple months. We want to respect that and see if this market will indeed test the 1755 level today, which I expect it to do, but it still needs to do that. So we need to see this market go down and do that probably within the next several hours, and then go from there and really watch and study this market to see how it reacts when it actually does do that.